most of us barely trade at a 50% success rate. But if you can reduce your risk on every trade and get out of the trades that go against you at very small losses, and you maximize your profits on the good trades, you will still come back with a positive account balance. And that's what's important. Netting out your losses against your profits so that you come out with a net profit in the end. Now, many novice traders begin trading without a trading plan. And this is one of the primary reasons why most traders lose. You know, I teach class all the time. I talk to lots of experienced traders, novice traders, you know, newbies, guys who have college degrees in accounting or mathematics and can't make a winning trade. And I have guys that have never been to university who make successful trades. Because trading is about planning what you're doing, understanding what you're doing, and having good risk management components. Somebody once told me that when you're don't have an active trade, you're just sitting on the sidelines. You can root for your team, you can scream and holler, you can yell at the quarterback that he did something wrong, you can tell the receivers are all screwed up, but you're just yelling at nothing. You're yelling at air because you're not in the game. When you open a trade, what do you think happens? Opening a trade is when you take on risk. It is the most dangerous thing you can do because you went from the sidelines where you had no risk into the arena where you have risk. So you can't yell at that quarterback anymore because he can run you down. And the only time you make profit is when you close your trade. So if you've got risk, you want to make sure that you've limited your exposure so that you don't end up losing your entire portfolio. Because like I said, many of us make bad trades. I do all the time. But a trade that you got out with a minimal loss, that you got out properly, is still a successful trade. Now, no matter how good you are, you need to expect the unexpected. Strict money management and risk control is essential to achieve long-term success in the markets. The high level of leverage available to traders makes it important to manage risk exposure and avoid over-leveraged positions. Now, say hypothetically you're trading an asset. Now, remember, leverage is controlled by the regulators. Okay, when you see somebody advertising 400, 500,000 on leverage, you know they're not a regulated brand. But say you're trading an asset that's got an allowable 50-to-1 leverage. You've got $1,000 in your account, so you can actually trade up to $50,000 worth of that asset. And say this hypothetical stock is trading at $100. Well, if you only bought the 10 shares with your $1,000 and the stock did good, it went up $10 a share. What did you make? You made virtually nothing. You barely covered your costs because you don't have enough of the market. But if you use the leverage and you had $50,000 to trade and you therefore could buy 500 shares of the stock and it went up $10, what happens? You made $5,000. That sounds wonderful. It sounds great. But the opposite always holds true. For every penny of potential profit is mirrored by a potential loss. So don't think you're going to get rich quick without any loss, without any risk. Now, the whole idea is to go into that trade with the possibility of making the $5,000, but by limiting your loss, by setting stop losses and exiting a trade when it doesn't go in your favor. So you bought the 500 shares of the stock. Instead of going up $10, it fell 50 cents. Well, you say, uh-oh, that's not what it was supposed to be doing. You close your trade or your stop loss automatically closes you out. Well, guess what? You lost 250 bucks. Well, that wasn't a big loss. You limited your loss. You didn't make your 5,000, but you didn't lose 5,000 either. So leverage can be defined as the amount of a trading position you can control with a given amount of margin, money placed on deposit as collateral. Also, the leverage ratio is the ratio of the amount of leverage to the amount of margin. In practice, a leverage ratio of 50 to 1 would mean that you control $50,000 worth of position with just $1,000 on deposit. While professional forex traders generally trade using the credit lines that banks and their counterparties extend to each other, retail investors like you and me, we must get leverage because we have to have a large enough position to make our risk worthwhile and even make our time worthwhile. So naturally, this high leverage ratio can act as a two-edged sword, since losses can accumulate as quickly as profits. Traders need to keep close track of their margin requirements for forex positions, since many retail forex brokers will simply close out losing positions when a situation arises where the margin in the trading account is used up due to adverse market conditions. In other words, you had $1,000 in your account. With leverage, you bought $50,000 worth of the stock, or 500 shares of that stock. Now, during the day, for some reason, that stock fell $2. Well, that means you've already used up the $1,000 you had in your account. Most brokers will then close your position because they don't want you to lose more of your account. And this is called negative balance protection. They don't want you ultimately owing the broker, but you don't want your account wiped out either. You wanted your position to close when the stock moved 50 cents against you, so you only had a $250 loss. So it's always important to adopt and maintain a neutral trading style. Don't let overexcitement and the thrill of real-time trading and seeing your investments rise and fall get you overexcited. Staying detached and objective about the investment while keeping emotions in check allows for clear thinking. In other words, have a plan. Write it down before you ever open that trade. What's my target point? At what position I'm going to close and be happy with the profit I made? Am I going to move my stop loss up as the trade moves in my favor? Will I move my stop loss down? Where am I going to place my stop loss? How much loss will I actually have? And understanding the types of stop losses is very important because it can help you lock in profit also. So things like when losing in trade after trade, lower your trade size by 50%. If you've had 2 losing trades, cut your trades. Too many people say, I guess what, I'm going to make money on that 3rd trade. I do that when I'm playing blackjack online. I have a losing trade, a losing hand. I have another losing hand. Well, now I crank it up to $500 because I know ultimately a winning hand's going to come. But it's not my money. I don't care. It's free money online because I don't gamble online. It's free money. I just play blackjack to pass the time. Okay. But that was free money. This is real money. The right way to do it is you didn't do good on this trade. You didn't go to the next trade. Cut your next trade by 50%. Okay. See how you do. Cut your next trade. You don't want to start chasing the losses. And if you don't do well by the 3rd or 4th trade, close your positions, get out, take the day off, go away. Now, 2, only risk up to 1% of your capital per trade. So in other words, it sounds really nice. You have $1,000 in your account, you can trade $50,000 and buy 50. The problem is you shouldn't because you're using all of your capital in one trade. You should have only been using and making a $5,000 trade and keeping the rest of that away for later. So stay disciplined with your entries and exits. Do not get sloppy. Do not abandon your method. You have to stay the course. So when your method comes back in favor, you can start making profit again. Don't jump all over the place. Have your plan. Don't change your plan trade by trade by trade, whichever way you feel today. Adopt the trading plan, adopt a set of behaviors and stick to them. And do not take losses personally. It's not your fault that the market is not being conducive to profits. It's not anything personal. You're not a moron. You made a good trade. The market's moved against you. It's not a personal thing. Okay? Close your position. Don't get your emotion involved. And do not fall under the temptation to let losers run. Cut your losses at predetermined stops, regardless of the pain. And do not stop tracking your watch list for the market you trade. Be ready to take the right entry when it presents itself. Many traders get so beat up on a string of losses that they stop focusing on their watch list and stop taking high probability entries. You have to be ready to jump back in the boat when it's ready to sail again. Just don't drown while you're waiting to get to shore. Now, what you always want to be is in control. Never wishing, always trading, and always first and foremost protecting yourself. That's why most people lose money as individual investors or traders, because they're not focusing on losing money. But that's what it should all be about. Monitoring your losses, getting out of the markets when you're losing, and don't pay attention to your profits. Your good trades, you've already set them up. They're going to hit your target point. They're going to close out, of your stop loss is going to move up into profit. Stop you. They don't need your concentration. What needs your concentration are the risky trades. Online trading is set up to be a rather risky endeavor. I always encourage new traders to go easy on the risk as they get started. The system is somewhat rigged to encourage risky behavior. So you have to set yourself up with a plan. When you think about leverage and being able to put up $1,000 trade 50, that's really an enticing thing. It makes you want to trade. It encourages you to take on risk. What you have to be is a person who doesn't take on risk. You need to be a person who is careful and considerate and aware of that risk every moment of time. The number one thing that you can do to manage your risk is to never trade money you can't afford to lose. Sometimes people skip this one thinking, that won't happen to me. But it really will affect your trading performance. If you are trading money you can't afford to lose, and you lose significantly or even face the threat of losing significantly, your decision making will be compromised and mistakes will happen. The second important thing is that you need to not let your eyes be too big for your stomach. If you don't know what that means, it means start small. Make your trade sizes appropriate for your account balance. And a stop loss should be placed on every single trade. A stop loss, now today, a stop loss is a very easy thing to place. It used to be that you had to place a complicated reverse order as a stop loss order. Today, when you set up your order to place it, it says, do you want to put a stop? What point do you want your trade to close? And you can either pick how many pips it moves against you, how many points it moves against you, what percentage it moves against you. And you also have what we call sliding stop losses, where you can tell the computer when you set up your trade to set my stop loss, say at 50 cents on that share, but keep it at 50 cents. So it means if that share went from $100 to $105, your stop loss moved all the way up to $104.50. So if the market then starts moving against you, guess what? You get stopped out, but at $104.50. So you made $4.50 per share. Now, if the market moves up to 107, that stop loss will move up right behind it to 106.50. And again, if the markets move against you. But you have to be aware of how to set them of what you're doing. You can also just set a simple stop loss. Say if the stock falls from 100 where you're buying it to 99.50, close my position. Plain and simple. But the trick is to set your stop loss at the right place. Because if you set it too close, you can't just arbitrarily say set it at 99.50, because maybe those shares trade often at 99.47. And they hit 99.47, they always bounce back up off of it. Well, if you set your stop loss at 99.50, you're going to get stopped out all the time and never make any profit. So you have to find the right point in which to set your stop loss. The stop losses should be considered to be your emergency exit. They should be set to execute when your trade has gone horribly, horribly wrong. Now, while managing losses is paramount to a forex trader, another key way to keep trading risk at manageable levels consists of recognizing when a profitable trade has run its course. And this is ultimately important. This third risk management concept involves using a trailing stop, which is what we've been talking about, to protect profits as a position moves in a desired direction. I love trailing stop losses. I use them for every single trade. Many traders make an initial move of their stop loss to break even once 100 pips or how many pips have been achieved. Moving the stop loss even further towards the present spot rate will further protect your gains once the trade becomes even more profitable. In addition, trailing stop losses allow you to follow trends as they unfold for maximum profitability. When a profitable trade has run its course, perhaps by observing a set of mutually confirming technical indicators that points to a market reversal, an efficient trader needs to close out his position. Remember, closing your position is the only time you realize profit. So trading with money that you can afford to lose in the worst case scenario, trading with a reasonable lot size, and controlling your risk with stops will prevent you from having a major trading disaster. These steps won't prevent you from losing money, but they will just give you a good chance that you might survive. Far too many traders take Wild West approach to trading, and sometimes it works out for a while, and others it's over. And this is why so many new traders come and a week or 2 or 3 weeks later they're gone from the market. They're talking bad about the brokers. They're talking bad about CFDs. Talking bad about forex. But it was their fault. They didn't employ any risk management. They just went in like it was a Wild West and expected to get rich. Trading while keeping your risk low will keep you in the game. Forex trading is a legit thing, but you have to be wary of the setup. You can make money if you don't get carried away by taking high risks. Speculating as a trader is not gambling. Doing gambling and speculating is risk management. In other words, if you walk through a casino in Las Vegas and somebody was throwing the dice on the craps table or spinning the wheel on the roulette wheel, you can't manage any loss. You can't have risk management. You're putting your chips down and you're gambling. When you're opening a trade based on knowledge and information, and you're setting stop losses and controlling your trade, you are speculating. You're not gambling. Now, the other thing you have to do is the other side of this, and that's called take profit orders. You should always set up a take profit order. When you enter your trade, you can tell the computer if this share is trading at $100, if it hits 110 at any point, close my position. Because you know what? Sometimes it'll trade at 100, 102, 104, jump up to 110 and fall right back down to 105.50. Well, if you had told the computer to close at 110, that 1 second it hit that 110, your trade would have been closed and you would have taken all of that extra profit. However, no trade should be taken without first stacking the odds in your favor. And if this is not clearly possible, then no trade should ever be taken. So remember the 2% rule. 2% or less per trade is highly recommended guideline. Always balance risk and reward. Before you make a trade, you should always know what your target point is for your profitability of the trade, where you would want to exit the trade. You should always know how much or where you have to put your stop loss. When you calculate the risk reward ratio between your potential profit and your potential loss, you should be giving yourself at least a 3-to-1 ratio in your favor. That means eventually your profitable trades will outweigh your losing trades. And this is the big one. Setting large reward to risk ratios come at a price. Don't Say, oh, I know this trade's going to make me money. So I look at that. The target I'm going to set up there at not at $110. I can set it at 125. And that means my risk reward ratio is sky high. No. Stick to what you have set up for you based on what you can afford to lose per trade. Okay. Don't adjust it to each trading scenario. Now, the thing you also have to keep remembering is there is a buy and a sell for every trade. Even when you have an open or close, there's just like when you go to the commission store when you're going on vacation, he'll buy the euro from you at one price or sell you the euro at another price. The difference between those two prices is known as the spread. That's really what the broker's charging you. Okay. It's expressed, it's there, you see it all the time. But understand, it's just like when you walk past the commission store, where the dollar is 351 today, we'll buy it at 351, but we'll sell it to you at 342. What's the difference? That's what the commission store is making. Okay. It's above board, it's straightforward, it's not hidden anywhere. But what you have to keep in mind is when you're setting your risk reward ratio, even though in this case, say we're looking here, the euro US dollar was trading, the buy was at 135.64, the sell was at 135.26. So if you were buying the euro because you thought it was going to go up, that's fine. But you also have to factor in the sell price with the spread that you need to get out at, not just what price it will hit for trading. Also, when you figure out your stop loss, okay, the sell price is not the actual value on the chart. It's got the spread in there. It's a small amount of money. It's tiny, tiny, tiny per trade, but you should always be calculating. You should always understand it. So if you were to reduce your position size, then you could widen your stop to maintain your desired risk reward ratio. Now, if you increase the pips you want to risk to trade to 50, you need to be able to gain 153 pips because 3 times is 150 pips, but the other 3 pips is factoring in the spread. So in other words, you need to be able to set your target point at 153, not 150. So to balance your risk reward ratio, you need to do this correctly. In the real world, risk and reward to risk ratios aren't set in stone. They must be adjusted depending on time frame, trading environment, and even entry and exit points. A position trader could have a risk to reward ratio as high as 10 to 1, while a trader could go for as little as 0.7 to 1. As a new trader, you should set it based on what you can afford to lose per trade. And be as conservative as you can. And a 3 to 1 is a good starting point for a new trader. So keep in mind, risk is inherent in every trade you take. But as long as you can measure risk, you can manage it. Just don't overlook the fact that risk can be magnified by using too much leverage in respect to your trading capital, as well as being magnified by the lack of liquidity in the markets. With a disciplined approach and good trading habits, taking on some risk is the only way to attract potential. No matter what you do, forget trading. A businessman who goes to invest or buy a business, somebody who's buying inventory, somebody's buying a house, each one of those has inherent risk. But the whole idea is limiting your risk. As Warren Buffett says, risk comes from not knowing what you're doing. Price is what you pay. Value is what you get. Someone's sitting in the shade today because someone's planted a tree a long time ago. So keep in mind, risk is part of making profit. Managing your risk is part of trading. You always take on risk every time you enter a trade. But if you know what that risk is and how to minimize it, you'll end up being a successful trader in the long term. So thank you very much for joining us tonight. I hope you learned a little bit about risk management and you think about stop losses and trailing stop losses. Think about your target points and your exit points. Think about your risk to reward ratio and think about where you should place that stop loss to protect you from losers, but also not letting you get stopped out of this market based on the swings of the market. So thank you very much for joining us. Have a great trading week, and thank you for being part of the Alvexo family. Good night now.